and introducing Scott Bessent, who is the CEO and CIO at Key Square Group, and also, depending on who wins the next election, might be the next Secretary of Treasury. So let's give a round of applause and hear about the intersection of technology and the macroeconomy with Scott.
Good. Thank you for having me here today. We study the past, imagine the future, and invest in the present is the one-sentence answer for what my firm, Key Square Group, does. We are a global investment firm that seeks to profit from medium and long-term economic trends. So when I was invited to speak at the Digital 360 Summit, I jumped at the opportunity to try and gather my thoughts on a topic that has been front of mind since ChatGPT leapt out of the lab and into popular use 2 years ago. I want to thank the organizers for having me here and be humble but provocative in delineating possible outcomes from this new technology for the economy. No discussion of the intersection of technology and macroeconomics can begin without addressing the elephant in the room: the emergence of generative artificial intelligence and its impact on the world. So I decided to ask ChatGPT to give me some insights. Here are the results. Digitalization and automation. Technology will continue to transform industries, potentially displacing jobs, but also creating new ones. Global interconnectedness. Technology facilitates global trade, investment, and economic interdependence, making economies more vulnerable to external shocks. Inequality and job market shifts. Technology can exacerbate income inequality if workers are not reskilled for new job markets. No hallucinations detected, which is positive, but also pretty generic. In my time today, I'd like to drill into more detail on the impact from AI on employment, inflation, and investment, the impact of income and wealth inequality, and the resulting effects on the government's fiscal balance sheet, and lastly, the impact of accelerating energy consumption for our digital future. We are in the very early innings, and there are many pathways that could be traveled, and hopefully this speech will spark some provocative thinking. And as I was writing this, I was thinking about one of my distant relatives, born in the 19th century in Charleston, South Carolina, gave an interview shortly before his death in the late 20th century. When asked about the greatest invention of his lifetime, Uncle Willie said, window screens. So the history of our economy is a history of productivity waves. Driven by non-linear technology advancement. You see some of them here. We've now gone roughly 20 years with mediocre productivity growth and the multi-trillion dollar question is if AGI represents the next crest of a new wave. Let's define what we're talking about here. What is generative artificial intelligence as perceived by the investment community in which I operate? We get the big headlines from OpenAI, Microsoft, Meta, and the like about trillion parameter open world foundational models that hopefully will lead us to true artificial intelligence, much akin to the Singularity for fans of the sci-fi genre. We're beginning to see a divergence in how the business world is thinking about AI. To date, larger models with open-ended data feeds had led to challenges with hallucinations, which can limit the benefit of the technology when attempted to deploy at scale within an enterprise. Where businesses are seeing immediate benefit in deployment is in smaller scale models with defined walled gardens, data sets defined by casual relationships and tasked with solving specific problems. Companies that can truly define the ontology of complex systems are using generative AI to communicate with their factories and resource systems to drive tangible workload productivity, we think of this more along the lines of intelligent automation. This technology has the potential to disrupt a much larger share of the workforce than prior eras. A favorite truism of the 1990s tech productivity was that you have to be fired to be hired. We'll see if that holds again. A much larger share of the economy is now knowledge and information based than ever before. Focusing on revenue per employee versus cost per employee is likely to be a major shift in enterprise focus. Back office jobs and expenses represent 15 to 20% of global enterprise expense structure and a larger share of the total employment. This will be a prime target for deployment of system automation, driving theoretical savings worth north of 80 to 90% for tasks such as order fulfillment, working capital management, auditing, and tracking. Another way this will influence employment is that small firms will be able to compete by hiring far fewer. It is estimated that a new software company can develop software at 1/10 of the cost of legacy software. DevOps and QA teams will see dramatic increases in workload efficiency. This is going to be seen most immediately in lowering the cost of headcount churn, and most companies will lower employee cost over time via attrition mitigation efforts. It's unlikely we see massive layoffs, at least not initially, but the pace of job creation is going to slow, as we're already seeing. In fact, if you take the most recent BLS corrections to the labor market, private non-government adjacent job growth averaged an anemic 20,000 per month level over the past 12 months. Now, a good chunk of this is driven by fiscal crowding out, but we believe you are starting to see the impact of AI on job formation at this early stage. Some leading edge prognosticators have predicted that the skills required for the prompt engineering jobs of the future will require a combination of proficiency in classical literature, philosophy, and applied physics. This is a skill mix in short supply today and likely to be an expensive and difficult transition for the existing workforce. If the government is required to step into the gap, as we can see on these slides, the problem is that the United States balance sheet has been stretched to its limits. Here you can see that for the first time ever, interest costs have surpassed that of defense spending and Medicare. Net interest costs have skyrocketed as the Treasury has chosen to finance itself at the short end of the curve. But the size of the debt itself has become an issue as we are running the highest deficits ever in a non-crisis environment. In any future stressed environment, deficits as a percent of GDP are going to reach double-digit levels. How does the government choose to deal with this problem? Let the bond market go, financial repression, let the US dollar weaken. Implications for forward inflation expectations, the bond market, currency exchange rates, and commodity prices will all be influenced. As we saw last fall, when Treasury rapidly responded to long-term rates crossing 5% by adjusting their quarterly refunding announcement and limiting long-term issuance, losing control of the yield curve is not an option, so that volatility is likely to move into foreign exchange and commodities markets. Exactly how this evolves will largely depend on how AGI permeates throughout the economy. We believe there is a divergence in how this technology is being actively deployed in the enterprise. We like to think of it as two different paths that may converge in the future, but as of today are fairly distinct. There is one model to rule them all approach, where trillion-plus parameter models with 100,000 GPU clusters are being designed to push the limits towards true AI. Think of it as open source AI that has access to all the information in the history of the world. There are thought leaders much smarter than we who worry that LLM scaling approach might never get there without quantum computing. Hallucinations seem to be increasing with the more parameters and nodes thrown into the model. The biggest companies are tackling the conquest of these frontier models. Others are taking the approach of localized AI, where AI models are being trained on causality to solve specific tasks and automate specific workloads. The more ring-fenced and controlled the data, the less the hallucinations and more beneficial the automation. Smaller test models can be linked together to increasingly tackle complex problems, and this can be done at a much smaller cost with inference that can be done locally. You see companies trying to tackle the open world approach, struggling with how to generate a return or even revenues. Companies applying AI automation techniques to define problems are seeing rapid returns. Yes, search driven by Gemini will be slicker and more targeted than Google's existing offering, but at the end of the day, it's still search that costs 10x more than a narrow path to monetization. Clearly, companies like Walmart are taking the more targeted approach. As companies tackle the low-hanging fruit with intelligent automation and margins begin to improve with declining headcount, stocks are going to re-rate as profits either drop to the bottom line or growth accelerates. This is likely to reinforce the growing evidence that the United States is a hyper-financialized economy where asset prices actually drive economic growth. Here are two charts that visualize this trend. ISM, a measure of business health, and CEO confidence, and by their proxy, willingness to invest, closely track the rate of change in the S&P. Increasingly, business decisions and consumption are driven by changes in asset prices. A productivity boom driven by intelligent automation can further supercharge this trend. If you are a shareholder or own tangible assets, you are likely to see accelerating returns. Capital will continue to be greatly advantaged over labor. This also makes it a fragile environment. Is this a paradigm shift in the capital gain? If there is a paradigm shift in the capital gains tax regime that impacts the value of capital, then asset prices can readjust violently, and there will be an immediate pass-through to the real economy via investment and consumption. As we embark on this productivity transition, it is very possible that we could see an acceleration in profits while experiencing an unemployment dislocation. With an economy that is heavily weighted towards consumption and consumption maintained by the wealth effect, the Fed may be required to maintain easier policy than economic data may suggest if AI is putting upward pressure on the unemployment rate, especially in the lower income quintiles. The wealth to income ratio rose again in the second quarter of this year to 7.8 times disposable income, the highest level ever, excepting the first quarter of 2022. At the peak of the housing bubble, that ratio was 6.8. At the peak of the dot-com bubble, the ratio was 6.2. This extra wealth allowed households to cut their average savings rate to 3.3% in the second quarter. It was 7% before COVID. And to prove this point, it is interesting that in light of a 20 basis point rise in 2025 unemployment expectations, the Federal Reserve just last week chose to cut 50 basis points, with the Atlanta GDP model now forecasting 3% growth and financial conditions easier today than they were when they first raised rates over 2 years ago. Perhaps the Federal Reserve has been thinking about AI. What are the nonlinear implications of these trends? Rising populism. Hi, we're AI. We just took your job and drove up your electricity prices 50%. In the long run, how is the country going to pay for this? Will the Fed be forced to ramp up its quantitative easing program again? Clearly, asset markets like the current macro backdrop. Let's think of some of the risks involved in this technology cycle. How do recessions happen? Recessions are primarily caused by an unexpected shift in supply and demand. They typically do not happen when every economic actor is worried and carefully watching every dollar spent or invested. They happen when there is exuberance, overconfidence, rapid growth, and eventually overinvestment. Where growth continues to exceed expectations, supply and inventories are ramped up to meet current and future demands. The problems happen when there is an unexpected demand shock and when the market must adjust to a new equilibrium. In the last 30 years, we've seen this in the internet and telecom bubble in the late 90s and the housing bubble in '05 through '08. Throw in complex financial leverage and you add fuel to the fire. Now turning to our current environment, we have seen many recessions in work from home, e-commerce, and retail consumer goods post the COVID shock and supply chain disruptions as supply struggled to match rapidly changing demand. But where we are seeing a dramatic increase in confidence, investment, and growth is in the AI space. Here you see an analysis from Barclays Capital. When you add up all the announced investment and look at Wall Street forecasts, we're building enough data center supply to create the equivalent of 12,000 chat GPTs. When you look at the total amount of platforms with more than 100 million daily average users today, after 25 years of growth, we get to a total of 50 platforms. These forecasts may be right, they may be wrong, but we believe you'll have to be cognizant of the risk that is now being built into the system. When Meta CEO Mark Zuckerberg says that it is actually less clear what is going to be the initial use cases for these things, for a lot of these things that are super valuable, and when the Microsoft CFO says the current AI capital expenditure may take 15 years or even longer to obtain returns, we have to understand this may not be a straight line. There's a risk of overinvestment and a capital retrenchment. What's more, in the internet era, tech was a relatively small part of the overall capitalization. Now it utterly dominates US indices, and US indices dominate global equity allocations. The Fed's flow of funds data show that 41.8%, I'm going to skip the slides. The Fed's flow of funds shows that 41.8% of household financial wealth was held in equities. At the peak of the dot-com bubble, the figure was 38.4%. Therefore, the fundamentals fall short of investors' expectations, or if there is a turn in the GPU cycle, the reflexive nature of the economy could quickly turn nasty. US exceptionalism is not an unknown entity, as you can clearly see here. AI brings to the fore a unique disinflationary possibility that could impact the tech-dominated indices that have attracted so much passive investment flows and made US assets very top-heavy. The CEO of Klarna recently told investors that it's shutting down a lot of the enterprise software apps it uses because it can replicate them all with AI. This consolidation, supported by AI, will help create a much more lightweight tech stack, allowing us to run the business more effectively and with higher quality. Conversational AI can understand natural language commands and be ordered to write software codes, so companies can cheaply and quickly build customized apps that do most of the things that traditional enterprise can do. This is a recipe for commoditization that the tech industry has largely been immune to for the past 3 decades. Microsoft is on its 3rd or 4th iteration of pricing its Copilot rollout as it struggles to find the sweet spot for its value proposition. Adobe and Salesforce have recently faced headwinds in communicating how AI will accelerate their top line, and most notably, Apple has prompted its vision of AI inference being done largely on device, negating the need for data-intensive inference flows going through the public cloud. These dominant tech companies are increasingly competing in one another's backyards with uniquely disruptive technology that has the potential to commoditize parts of the tech stack that heretofore have been monopolistic characteristics and margins. We've seen this many times throughout financial history. There is a paradigm shifting new technology. We see a narrowing in the market of investment dollars flood into companies involved in selling picks and axes. These stocks tend to become overweighted on our stock indices. There's eventually a shakeout, either through slowing growth or a pullback in investment. But as the technology matures and overbuilt infrastructure allows for rapid price depreciation, adoption of the technology becomes widespread throughout the economy, and economic value accrues to the customer who can implement these new tools. The NASDAQ underperformed for a decade post the internet bubble, but there were tremendous opportunities down the market cap table as companies deployed and benefited from the prior overinvestment. Something to think about in the current environment is to look for historically lower margin, back office, intensive industries that could see a dramatic improvement in margin as a result of smartly deployed automated strategies. What about the rest of the world? Emerging markets with no legacy cost structures can immediately benefit from new technology deployment driving rapid growth. New business formation and growth can lead to substantial outperformance. Again, these are things to think about. Right now, everybody is on one side of the boat. Lastly, I'd like to touch on energy and the impact new technologies are having. Frankly, here is where the change has been nothing short of revolutionary. Electricity demand across the nation has essentially been flattish over the last two decades. The new impact from data centers alone is now moving the needle nationally, with demand for electricity now forecast to grow at 2% for the next 15 years. Virginia is a hotbed of current data center demand, and here you can see how this has specifically driven total commercial demand, offset it, limited demand growth in industrial and retail, and Virginia has outpaced the rest of the country with regards to demand growth. Virginia is now increasingly supply constrained, and because of this, the hunt for data center supply has gone increasingly national. In March of this year, the investment world was shocked when nuclear power producer Talon Energy announced it was selling 960 million gigawatts cumulus data center campus adjacent to the Susquehanna nuclear power in northwest Pennsylvania for $650 million to Amazon. Talon has agreed to supply 1 gigawatt of nuclear baseload power to the facility, or nearly 40% of the total capacity generated by the facility, once the data center is fully complete in the 2034 timeframe. Not to be outdone, Microsoft just last week announced that they were signing a framework agreement to bring 3 Mile Island unit out of retirement with Constellation Energy. My guess is that co-located data gas turbine facilities located just west of here in the Permian will become a topic of very hot discussion. When you combine this data center demand with the coming increase in demand from the implementation of the Inflation Reduction Act and the electrification of everything, 2% demand growth may be on the very light side. Big companies know there's a shortage coming, and that is why they're willing, if not desperate, to sign premium long-term contracts today for guarantee of supply tomorrow. Some staggering numbers from Canadian environmental scientist Václav Smil. According to EIA data, as of 2011, the United States economy consumed 73.5 quadrillion, with a Q, BTUs of energy. Of this amount, all forms of electricity only supplied 24% or 18 quadrillion BTUs. If we were to give electrification the benefit of the doubt of a 50% efficiency gain, this would require electricity to provide 28 quadrillion BTUs to maintain living standards, or 156% of what the entire electricity system generates today. All of this comes with a cost. All the capital to be invested, the transmission lines to be built, the emissions targets to be hit all require a return on investment, and the numbers are staggering, running into the trillions. In certain regions, renewable targets are being implemented along with forced retirements of existing baseload. And just to reinforce this, there's a bottoms-up forecast from Wolf Research. Baseload supply is what is required to fulfill demand at peak. 0.37% growth is not going to get us the current 0.37% growth is not going to cut it if future estimates are remotely accurate. You see what electricity prices have done in the past 4 years, plus 30% according to Federal Reserve data. And this is before AI data center growth exploded and the implementation of the IRA. I would expect this trend to continue, if not accelerate. What strategy should a group of quantitative realists, like all of us here today, employ when you don't have the answer? Bring God into AI. So I was thinking about it. I remember the Gospel of St. Matthew. They seek a sign, and no sign shall be given to them. My friend, mentor, futurist, and legendary investment strategist Kirill Sokolow told me in 2002, China isn't a thing, it is the thing for the world economy for the next 20 years. And boy, was it ever. I'm here today to tell you the same thing about AI. It is not a thing for the economy, it is the thing. I have enough humility to know that I can't comprehend all of the pathways, but our Keysquare investment process is extremely iterative, and I would love to hear any of your thoughts at ir@keysq.com. Thank you.
Okay, let's give a round of applause to Scott Bessent. Okay, I think if you're open to it, we've got time for just a couple of questions. Does anybody have any questions? Don't be shy.
Thank you for being here, Scott. What's your take on innovation in America? You know, a lot of people say that we're in decline. A lot of people say that we're, we should be afraid of China. We're going to lose position. I continue to be the ultimate optimist. I believe in our greatness. What are your thoughts about what we can do with innovation and how we consume innovation and put it to work to get better, to learn from a government and private sector?
Yes, so I look back at the history of the Manhattan Project, and I think I was fortunate enough to be on a Zoom with Eric Schmidt about 6 months ago, and he gave us a tour of the world and his thoughts on AI. And he said, look, with China, the Chinese, the CCP, will never let AI, like the serious use cases, into private industry, because at the end of the day, the CCP is afraid of the people. So it will be harnessed with military, with government, and subject to a lack of innovation. And he then went to Europe, and unfortunately also to the UK, and he said that they will regulate it, and they will not get the growth. And he said the US, we're just going to let it rip for the next 2, 3, 4 years. Hopefully we don't blow ourselves up. And he has a plan for rational guardrails, and we'll go from there. So yeah, I think, like with everything else we've seen in the past decade, the US is going to continue to lead.
Got one question here.
Hi, I have a question. I do a lot of business with Mexico City, and everything I've seen there is times 4,000 just because of the demographics. And they often ask me, what's going on here in the country, in the United States, that can be imported, or well, can be exported there, and beneficial in an economy that obviously has all these issues, but 10 times because also is a matter of economy. So my question to you is, how do you feel that we as being in an American economy can contribute to the world with the solutions that are being created in this exact room?
Well, I think of it as, Mexico is obviously getting to be a very developed country, but in a place that did not have the same advantages of office automation processes, that the ability for AI to be leapfrog technology could really be powerful. I think a few years ago, I was on a safari and I was in Kruger Park and I had 5 bars on my cell phone. I can only get 1 bar on my cell phone in Central Park because they had a terrible landline system in South Africa, and they just jumped straight to cell phones. So maybe the fact that there's not an incumbent in the way could be quite powerful, and could contribute to margins. The other thing I would say, we're all reading, and again, this is just something I'm throwing up against the wall that I've been thinking about a lot. In an era where developed countries, developing countries, China, and others are seeing population decrease, perhaps we don't have to view population decrease as economic death. And actually, maybe Japan could be in a great position because they won't see, if we see a contraction in the need for labor, if you have less labor, maybe somewhere like Japan, Italy could get to an equilibrium point where having fewer workers is better, whereas the US, which is about at equilibrium, we have a pretty good replacement ratio, that it may be a problem where we have to, what are we going to do with all these workers?
Okay. This was great. This was so insightful. Thank you, Scott. Let's give him one more round of applause.